Hey, everybody, it is September. I cannot believe it's September already, but it is. We are in the latter third of the year right now. So, we're going to talk about some of our favorite buys in the market right now. It's a really interesting time. The stock market's been kind of volatile lately. We don't know what's going on with interest rates, and we don't know what's going on with the U.S. economy in general. A recession's not totally off the table yet. And it's kind of created some interesting bargains in the market. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So Tyler Crowe is joining me. Welcome to the channel, Tyler. I feel like it's been a little while, but I guess it really hasn't.
We both got kids. It was summertime. Every single time we'd go to do it, be like, kids. And we'd have to push it off to 3 weeks later.
Yeah, but well, we're back in the groove now. I guess I would say. We're actually recording this in the morning, my time, which is a nice little change of pace. I'm the closest thing to a morning person you're going to find around here. So, all right. So I guess I'll go ahead and kick it off. My top stock idea for September. There's a few that I've been buying lately. We're going to do a few other videos about. There's actually a Chinese stock I've been buying lately. A few real estate stocks. I've been buying quite a few ETFs. I've been indexing more than is characteristic for me this year. But I have to say my favorite stock idea right now is GM, General Motors, and they're making progress in all the right ways. And I feel like they're doing better at developing an EV strategy than their rivals are. I mean, obviously not companies like Tesla, although, the Cybertruck, we can argue whether or not that's a good EV strategy. Um, but in terms of like the legacy automakers, quote unquote, I feel like they're doing a really good job of getting the EV rollout down. They're leveraging their customer loyalty. The Silverado EV was a priority of theirs. There's a lot of potential in their EV rollout over the next decade or so, and not just in the models that they already have. They're developing some new models. They were kind of a pioneer at the lower end of the range with things like the Bolt EV. They're doing like smaller SUVs. In the EV industry right now, the let's say $70,000 to $100,000 price point is a very crowded market. Yeah, that's pretty much been Tesla's bread and butter. That's where Lucid makes most of its money. It's becoming a really crowded market. A lot of the legacy automakers are rolling out models in that range, and GM's kind of operating a little bit outside of that range, which I really like. Um, it's an incredibly cheap stock. I have to really kind of dig in and remind myself why it's cheap because there is a reason. But it trades for about 5 times earnings right now, five, despite having a net cash position in the automotive business. There are some risks. Obviously, the automotive industry is a cyclical one. Profit margins are higher now than normal. That wouldn't be the case if there were, say, a recession to come. That 5 times earnings multiple would get bigger real quick. And there's a lot of finance risk. I said GM has a net cash position in its automotive business. That's not true overall. It has a lot of debt related to the financing business it owns, GM Financial. So it has a lot of credit risk exposure as well that could turn sour in bad times. But I think they're doing things right now. The EV rollout's doing great. The market's essentially ignoring Cruise after its kind of missteps over the past couple years. But Cruise just announced that it is partnering with Uber for driverless paid ride sharing services. They also partner with Waymo, so this isn't an exclusive partnership, but it's significant traction for a business that essentially gets no valuation in this equation. So that could be a nice bonus. And GM is buying back stock. Tyler, I love companies that are buying back stock aggressively. I know that's a big part of. You've talked about it before. You like when it's done in the right way. When a company's trading at 5 times earnings, GM has bought back 18% of its outstanding shares in the past year. I don't know of any other than maybe a special situation. I don't know of any buyback that aggressive. They just reauthorized some buyback. Again, not without risk. There's a lot that could go wrong here. Um, but just from a risk reward perspective, I really like GM here. Tyler, if you have any comments on GM, feel free to shout them out there.
Well, I did want to point out because when it comes to automotives, this isn't, for people who may have not necessarily see autos often, do keep in mind too that this is never an industry that's going to trade at a multiple like at the S&P 500 level. Like you're not going to expect like, oh, one day it's all going to be trading at 25, 30 times earnings because that's what the market is
Unless
for,
earnings
the
drop
broader
a
market.
lot.
Oh, I mean, yeah, unless there's a huge earnings drop. This is an industry that habitually trades from 5 to 10 times earnings. This is not like some very, very unique end of it. Yes, it's on the cheaper side for automotives, but it's not like the most egregious sort of situation that you'll see in autos. So, just keeping that in mind, so people aren't expecting some sort of like re-rate up to like S&P 500 kind of levels. So you said you like buybacks, right? So can I interest you in a company that has bought back half of its shares in the past 5 years?
Yes, please.
Okay. So let's talk about SLM Corporation, which again, that's a very benign name and doesn't describe anything that it does, but you may know it as its former name, which is Sally Mae, the kind of pseudo government service entity that it was designed to, kind of be the Fannie Mae, Freddie Mac for the student loan industry. Basically, like kind of be a create liquidity in the market for it by like buying loans that that qualify for it. And it's a little bit different now because they bought a bank and they actually have deposits now, so it's a little bit closer to a bank in that sense. But you have this unique entity where all it does is originate student loans versus credit cards or auto loans or anything like that. It's all student loans, which has a lot of advantages. Number one, they cannot be like forgiven in bankruptcy, right? They're student loans. They often they have to be co-signed with a parent or somebody that is doing it. Just for example, in the year 2023, 87% of the loans that it originated were co-signed by somebody else. And, one of the things that we think about too is when it's kind of a bank, we think of net interest margins, right? The difference between what you lend out and how much you actually have to pay your depositors. When I hear like 5%, I think like, oh, that must be pretty high credit risk because like, I don't know, probably credit card loans or a lot of like auto loans that are collateralized with autos or something like that. But no, this is kind of the interest margin range that we're looking for in student loans. And again, I would consider a much more secure, less risk of credit default relative to something like a credit card or an auto loan or something like that. And so kind of keeping all of that in mind, SLM Corporation for these past few years, I know, yes, COVID made things really wonky. There was a lot of like moratorium on payments and things like that. This is not as much of an issue here because most of SLM's corporation's originations these days tend to go towards graduate student level loans. So people going for MBAs, master's degrees, PhDs, things like that. It doesn't quite have the lack of payment or can't pay their bills because all these people have pretty high paying jobs when they get out of it. So again, I'm trying to kind of capture like why this particular like these businesses or these loans actually make sense. So on top of that, you have this very secure loan at good margins. It has about a 51% return on common equity right now. It has a 14.7% tier one capital ratio for its banking aspect of it. So it's very liquid. Or it has a very high return on equity, on top of, from a bank perspective, would have a very robust balance sheet and a business that's just been returning a lot of capital to shareholders, either through its dividend, which currently yields about 2%, not great, but has been buying back a lot of stock to kind of manage the balance sheet. And today trades for about 6.8 times trailing earnings. So I think we're looking at a pretty good bargain in an industry that is not talked about that much because it's student loans. It's kind of a very niche industry, but a business that has done quite well for its investors over time. And I think the way that management has been managed, kind of handling its credits, situation lately, I think it has a very good chance of doing well.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.